Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory, and today we thought we'd come to you with a top 10 list for 2024. A little bit of a review of what happened in 2023, as well as some of the things that we're looking out at for 2024. And so with that, we will get started. First thing that we are focused on. 2023 is kind of going to go down in market history as the fantastic year in the markets that didn't really feel like it. The S&P 500 was up about 26%, a little over 26%, including dividends, right around 24% just on a price level. But about 16% of that gain occurred in the last 2 months of the year. And so as we've been talking to clients, as we've been, reflecting on 2023 and what that felt like, it certainly hasn't felt like a year in which, the market went up by 20+%. I think that a lot of that is from the fact that, most of that rally, almost 2/3 of that return occurred from October 27th through December 30th. So right there at the very tail end of the year. Clients will certainly see that on their year-end statements, but if you were to survey people in mid-October about how the year had gone, you would have gotten sort of a very ho-hum attitude. And so I just want to, be the first to get out there and cheerlead a little bit and say, hey, 2023 was a great year, and we should all celebrate that, as we look forward. Number 2 on our list of top 10 things that we are looking at. 2023 will also go down as the year where the Nasdaq came roaring back, posting about a 43% gain over the course of the year versus the Dow's more modest sort of 13-14% return. Really a year where there were about 7 stocks, the Magnificent Seven, that really drove the vast majority of return for the year. All 7 of those, if we rewounded this time last year, it was right around the beginnings of the AI craze. All 7 of those stocks are these sort of technology growthy companies that just had fantastic years in 2023. Really drove a significant portion of the market's return for the year. And it's funny because, if you're a tech stock enthusiast, if you're one of these people that's like, I always want to own growth, then you will point to 2023 and say, yes, there is the example of why we own growth. And if you're more of a value enthusiast, I just remind you that on a 2-year stacked basis, the Dow's return is about positive 4 or 5%, whereas the Nasdaq's return is about negative 4 or 5%. So the fantastic year that the Nasdaq had in 2023 doesn't quite make up for the terrible year that it had in 2022. So if you're a value stock enthusiast, you also have something to crow about. And it's, always interesting at these points in times of the year where, regardless of whether you're value or your growth, you have something to point to and be like, hey, we're really excited. Point number 3 that we would make as we reflect on 2023 and think about 2024, it was this time last year when my phone log and email log was just absolutely filled with everyone pointing to the death of the classic 60-40 portfolio. 2022, not a great year for the 60-40, a return of less than 10% in that particular year. Everybody's familiar with it. We don't need to rehash it. But I will point out that it was during that time, early 2023, that everybody came and said, well, is, traditional portfolio management broken? Should we be thinking about something other than a 60-40? Because gosh, look at how horribly that has performed. And so I'd like to just, take the point at this point in time and say, hey, that classic 60-40 portfolio returned about an 18% return last year. Which is pretty phenomenal. Will go down as one of the better years that the 60-40 has ever had. And so rumors of its demise have been greatly exaggerated, as we made the point earlier in the year with videos, just because something doesn't work once or maybe 5 times over the last 100 years doesn't mean you throw it out. And in fact, hopefully you did not in 2023 because it came roaring back. We'll now move away a little bit from the historical look back on 2023 and start to focus a little bit more on 2024 with point number 4 on the countdown, which is predicting the end of the year. This is the time of year where everybody likes to put on their sort of prognostication hat and give you a forecast for where the Dow or where the S&P is supposed to be. And we're not going to do that because that's silly. The data would sort of consistently suggest that all of those forecasts are wrong. Pretty much everybody does the same thing every year, which is forecast about a 10% rise in the equity markets. They do that because that's been the long-term historical average return of the equity markets. And they'll put a bunch of, research behind it, and then slap a level on the S&P 500 that's probably, somewhere a little north of 5,000, 5,200, somewhere in that range, 5,300. We're not going to do that. Instead, we're going to show you the charts of how wrong those forecasts were back in 2023. The average prognosticator that engaged in this had a year-end forecast for the S&P that was right around 4,000. The S&P closed right around 4,800, so off by quite a large amount. And I would just note that if you go back and look at the historical accuracy of those predictions over time, they're sort of silly. We don't really know what's going to happen over the next 12 months. That's why we tell you not to market time. And so instead of actually offering you a prognostication, we're just going to kind of make fun of it. So that's point 4. Moving on to point 5, as we look out over, and this is probably the one that everybody is a little bit more focused on, as we look out over the course of the next 12 months and think about where the economy is, it seems pretty clear based on the months of November and December and the sort of economic performance that came out of those 2 months, as well as the inflation and employment data, as well as some commentary from the Fed. It seems pretty clear that we have reached the peak interest rates for this cycle. So inflation has come down to much closer to that, 0.1, 0.2% month over month level that the Fed wants to see. We're not quite there yet, but we're very close. Unemployment has started to creep up a little bit, maybe look a little bit softer than where we were running. Wage growth, a little bit softer than where we were running. And perhaps most importantly, Powell and the rest of the Fed have sort of come out and said, hey, we don't have to be at that 0.1, 0.2% number in order for the Fed to go ahead and start to lower rates off of peak. So they pretty much come out and told you that, they're never going to say never. They pretty much told you that they think that we've reached peak rates for the cycle, which means the next move for the Fed is probably lower. And that is certainly the cheering and kicked off the sort of rally in the market that we saw in November and December of 23. I would say that the timing of when that first cut comes is still kind of up in the air. So in peak market exuberance, the market was thinking that, it's going to happen in the first quarter, probably March. That's the date of the first cut. We've seen a lot more positive economic news, or a little bit stronger economic news here in early January, which are leading people to say, maybe it's not March, maybe it's, a couple months after that. And that's going to kind of play around a little bit with where that 10-year Treasury settles out with, and a little bit with where equity markets settle out at. We need to see a little bit more weakness for the Fed to start to cut, or at least confirmation that we're not going to move in the other direction. I would remind everybody that when we get these big equity market rallies, and when we get the 10-year Treasury that moves from 5% to 4%, when we get people feeling better about the economy, that's all stimulative. And so that stimulus will then show up in a little bit stronger economic numbers later on. And so it's not surprising to me that here in the first couple of weeks of January, you've seen a little bit of consolidation around this level, a little bit of maybe unsurety as to whether or not, when that next cut comes, or when the first cut comes, really. It's not surprising, and I think we're probably going to be in that conversation cycle until the Fed actually does go ahead and lower rates. Not a bad thing for the market to kind of consolidate, but just understand that we're not quite out of the woods yet on, okay, when are we going to start lowering? What's the pace on that? But the good news is, at least it looks like we're at peak. And number 6, probably the single greatest thing to remember is, there are no hard and fast rules, right? Everybody would tell you that, the rule of 4%, for example, is a general guideline, not a rule, right? Or whatever else you want to look at, there's no absolutes in life. And the phrase, don't fight the Fed, is one of those absolutes that, is not always true. But it is a phrase for a reason. And that is that as the Fed starts to lower interest rates, as they start to put stimulus back into the economy, or at least become less restrictive of the economy, it is generally a positive thing for equities. It is generally a positive thing for companies because it means the economy, all else equal, will grow a little bit faster. It is generally positive for equities because lower interest rates means higher multiples. And so I would just note for everybody as you start to think about 2024, and we're going to talk about economic forecasts in a few minutes, don't fight the Fed. Generally when we see markets where the Fed is lowering interest rates, that is positive for equities. It's also usually positive for some of the sectors that I think have been most beaten down over the last year or two, including international stocks. And I will just point that out, that as the Fed lowers interest rates, as U.S. interest rates come down, the dollar normally weakens relative to international currency, and that leads to higher international equity prices when you denominate them in dollars. So generally what I would say, probably the rosiest outlook certainly that you've ever seen out of RFG. Once again, we're not market timers. Don't try and time this. We'll talk about that in a few minutes as we get further down the countdown. But generally the outlook, I would say, is fairly positive. I would also say, as we come to point number 7, it's probably time, if you haven't already, to maybe push aside that, hey, I should just leave all my funds in that, 5% or 5.5% 6-month CD that I just found. And the reason why is this, if you go back and look over time, this was a very, very popular investment strategy for much of 2023, even late 2022. Had some bad years of financial market juju and people looking at it and saying, hey, maybe I should just park my cash in some sort of fixed income security that's going to pay me, 5.5% or 6%. Why wouldn't I just lock that in? And the answer is that there is an opportunity cost associated with that, and that was never more clear than in 2023. That Treasury rate of 5.5% on the short-term side was certainly attractive versus history. But if you looked at where other asset classes returned in 2023, you would have been better off owning any amount of equities and some long-dated bonds than owning that lower yielding security. And I would just note that has historically been true over time. When we start to look at, peak interest rates for a cycle and look at what people earn on, those cash or cash-like securities versus what they could earn in longer-dated bonds and equities and a wide range of other what I'll call more risky securities, there are very few periods of time where it was actually a better idea to hang out in those cash-like securities. So we just encourage you guys, if you're thinking about this, obviously talk to your advisor. Come get some advice. Think about where you should be allocated or where you shouldn't be. But it's probably time to start thinking about maybe rebalancing out of some of those all-cash securities and maybe taking a little bit of a broader look at what the investable universe is. So I'd encourage you guys to do that. All right, point number 8. I would also just note that there are a number of the prognosticators that are out there that are sort of calling for a mild recession this year. So the thought process being, hey, every time the Fed raises interest rates and then, gets to a point, they always overshoot and we always wind up with the economy slowing down. And look, the unemployment rate is approaching 4%, and that's going to continue to go up. And that has to mean that the economy is going to slow down. And if it slows down, it's got to go negative for 2 quarters, which is the technical definition of recession. And so we should be really looking for a mild recession midway through the year. And so, all of these rosy forecasts are probably a little too aggressive. And I would just say a couple things. The first is, I'm squarely not in that camp. I think that the Fed probably has gotten us in a good position for a soft landing. We've thought that for a while. And the second thing that I would say is that the emphasis on that phrase of mild recession should be on the first word, mild. It is certainly possible that the economy slows down a little bit midway through the year, maybe even goes negative. I don't necessarily see it myself, but I can understand how other people might. It's not forecasted in any forecast that I've seen to be the type of 2008, 2001 style event that most people think about when they think about recessions. Probably more like a 15, 16 style event where the economy slowed, but maybe didn't actually got close to stall speed. It didn't actually stall out. The other thing that I would just point out on this is, the market tends to be a forward indicator of economic activity, not a lagging indicator of economic activity. And so if you look at where the market has gone and how it's gone down and then gone back up again, the equity markets are certainly telling you that they do not expect a contraction in earnings this year. Most recent forecasts that I've seen have shown kind of a 10% earnings growth for the S&P 500 consensus. That throws a little bit of shade, as my kids would say, on this whole notion of we're going to get a recession midway through the year. We're certainly not in that camp, and I don't think the market really is either, but there are some forecasters that are calling for it. Number 9 on the list, and this is going to get a little bit tactical. You guys know us, and you know that we don't recommend market timing, but we do recommend rebalancing your portfolio from time to time. That process of rebalancing, for those of you who aren't aware, I've got equities and I've got fixed income or other safe assets in my portfolio, and I'm targeting maybe 60% equities and 40% bonds, or maybe those are different ratios depending on your risk tolerance. And you look up at the end of the year or maybe the beginning of a year and you say, wow, my equities have done really, really well, and my bonds did well, but it didn't do quite as well. And so instead of being at 60-40 or whatever my ratio is, I'm off of that some ways. And so we do this process called rebalancing, where we basically sell what our winner was, buy a little bit into our loser. I would encourage everybody, to the extent that your portfolio is set up in that fashion, now's a good time to think about rebalancing. We're here at the beginning of the year. We had a very, very strong equity market rally to close out 2023. There may or may not, depending on if you're in qualified or non-qualified, be tax consequences associated with selling some of your winners and buying some of your losers. You can obviously look at that at the beginning of the year, but even if there are tax consequences, we've got, 13, 14 months before you really have to think about paying those taxes. So really a great time of year to sort of think about getting the house in order and getting reset. And for those of you who are concerned that the equity market has run up significantly and maybe there's a correction coming around the corner, what I will tell you is please don't market time. It's historically, there's never really been a good period of time where that has been a winning strategy. But rebalancing is a different thing. And it may actually, depending on what your portfolio is allocated to, get you to kind of the same result, which is selling some of those equities that did really well in 2023, buying a little bit of fixed income, and reestablishing that kind of risk tolerance that you were looking for originally in your portfolio. Which brings us to the last item on the list, item number 10 of what we're thinking about for 2024. And I would just point out that it is an election year. We are still very, very early in the election process. Unless you've been hiding under a rock somewhere, you are well aware of what the status of the campaign trail is and who the major players are. I would point out that, if you dig a little bit deeper, the presidency is always a toss-up. The House of Representatives is also always a toss-up. There will be a fierce battle for control of the Senate this year, and things actually don't really stack up well for the Democrats in that regard if you just look at the number of seats that are up for re-election and who has to win what. So all of that said, it will be an interesting year. I would encourage folks or remind folks that we are still very, very early in the election year. We still have a lot of ground to cover. And I go back to, the first Obama election where it was this point of the year where Hillary Clinton was the front runner and no one had even heard of Barack Obama. And certainly by the time of the November elections, that had changed dramatically. Would just note that there are a lot of things that can change between now and November. So everybody, keep your eyes glued to the screen. Keep your eyes glued to the screen, but we would encourage you, regardless of what your politics are, please don't try and invest your politics. One of the classic blunders that we see in terms of timing markets or portfolio maintenance or anything else like that is this notion of, my party is going to win or lose, and thus I should be scared, or thus I should be more aggressive. And historically, that has not really worked out all that well for folks because it's not just about timing what happens in the election, but it's also about trying to time what the market's reaction is to the election. And the data is very, very mixed on that. There is no consistent theme for one party is better for the markets than the other, or one party or split control is better than non-split control, or whatever that might be. It really is a case-by-case scenario, and also very much dependent on what the market's expectation was going into election night versus what actually happens. So grab some popcorn, keep your eyes on the screen, get out there and get active, vote if that's something that you find interesting, but please don't try and time the market with respect to elections, because that rarely winds out working out well. So with that, we hope you've enjoyed the top 10 list. As always, if you have any questions, please reach out to myself or to your advisor. Look forward to talking to you again soon, and I hope you're having a great year.